Hello and welcome to CIMA F1 Financial Operations. This is chapter 12 and we will cover associates. This follows the chapter that where we covered subsidiaries, and this table in front of you, it gives us a good basis for a recap. So imagine you can purchase shares and let's say we're purchasing 2 shares in British Airways. How are we going to deal with that? We are a company and we purchase 2 shares in British Airways. What's the level of influence you think we'll have over British Airways? Arguably none. Therefore, these 2 shares we purchased, will treat them according to financial instruments, IAS 39 and IFRS 9, and will basically do the following entry. So let's say we paid cash, so credit cash, and debit financial asset. So it's pretty much an available for sale asset. What happens if we have billions and we can buy 80% of BA? What happens then? Well, anything more than 50% based on voting shares gives you control. Even if in this paper we'll talk about 100% ownership, so nothing in between 51% and 99%, control is given for voting shares for owning more than 50%. So what happens then? Well, that's a previous chapter. We're dealing with a subsidiary. You exercise control. And there are basically various rules for consolidation of financial statements of your parent and the subsidiary. So what we do is line-by-line consolidation of all items under parent control. Also, you calculate goodwill. So here we talk about assets, liabilities, and in statement of comprehensive income, you will have the profit consolidated. But now this chapter is introducing the situation where you do not have control as above, but you buy more than 2-3 shares. Let's say we buy in BA somewhere in the region of 20 to 50%. What happens then? Well, clearly you are not a negligible shareholder. You have what is called a significant influence in the operating and financial policies of the company. And for this paper, that will be given to you mainly based on percentage. Note, once you decide that you're not dealing with a subsidiary because you don't have control, but you may deal with an associate where you have significant influence over that associate company of yours, you're going to use different rules for consolidation, and that's called equity accounting, which is a very, very simplified version of consolidation compared to what you learned in the previous chapter on subsidiary. Remember, in real life, life is not that simple. It's not about just the percentage holding, but you will have to look in the substance of the transaction, which it's important to know for this paper at a discussion level, but you're not necessarily going to be given a scenario to pull out data and look in the substance of that particular scenario. However, you have to be aware that sometimes, let's say you may have 15% voting shares, and you may have a significant representation on the board of directors, which together may put you in a position of significant influence. In fact, it may give you a position of control as well. Also, you can combine whatever voting shares you have with these aspects of substantial evidence that the investee company is used to accepting the investors having significant influence, whether the investee is part of the supply chain of the investor. Do we share key personnel? Do we share key information? So such sharings add to your power of influence and add to the power that the voting shares alone give you. So these would be elements for you to be aware of. It's not just about percentage. However, in the exam will be quite limited to that. What happens in terms of accounting treatment? So if you look at we have here page 52, that's correct. And let's very briefly summarize the theory of the accounting for an associate. So if you have the statement of financial position, this time for an associate, so obviously you'll have as at a point in time, but you're dealing with parent plus associate company, you're not going to apply the same rules. You're not going to consolidate line by line assets and liabilities. All you will have a special line that will be called invest in obviously non-current assets You will have a special line, investment in associate. That's all. And how will you calculate that? Well, there are two ways of calculating it, but I'm suggesting you to focus on this one, which takes the investment of associate which is given, plus proportion of post-acquisition profits, which you may have to calculate, and in F1 we said this is 100%, so post-acquisition profits. And let's not forget, from this investment in associates figure, we take out any impairment losses. So that happens on the statement of financial position. On the non-current asset, one single line inserted. All the other elements remain of the parent company only. You consolidate the retained earnings as we covered in subsidiary, so we can move into the statement of comprehensive income. Again, here you have just one line above, so you'll have to look for a line above PBT. And that line will be called group's share of profit of associate. So share, let's make it share of associate profit. And how do you calculate it? Well, you take the associate's PAT and you apply the percentage of ownership. That's all. That's what you have in statement of financial position. That's what you have in statement of comprehensive income, respectively. What happens with other adjustments? Remember that any intercompany between a parent and associate you ignore, are no adjustments. Do you, or hopefully you do, remember that provision? So in terms of adjustments, you had for subsidiary that PUP, provision for unrealized profit. Remember, you will adjust only for group portion, group share. And that provision for unrealized profit always will decrease the consolidated retained earnings. But also you have to pay attention to get the other side of the double entry. Who has made the sale? Is it the parent company to associate, or is it the associate to parent company? If the parent company sells, then you will have to reduce consolidated retained earnings, but also reduce the investment. If it's the other way around, associate sells with parent, you do reduce the consolidated retained earnings and you reduce inventory. Okay, so that's one distinction in terms of adjustment for provision for unrealized profits when you have transactions between parent and associate. I hope you find useful these highlights. Best of luck with your preparations and best of luck in the exam.